Okay, so think about this for a second. You got paid this week. You see that number hit your account, and it looks pretty good, right? But then you just watch it disappear. Rent, a car payment, that subscription you totally forgot about, taxes, and you're left wondering, wait, where did it all go? That feeling, that confusion, that's what we're going to tackle today. We are going to demystify your money piece by piece.
So, what is this number you're looking at? $948. That's not random. That is the average amount of money Americans lose every single year. Why? Simply from not understanding how money works. It's not bad luck, it's not laziness, it's just from a system that nobody ever really sits down to explain to us.
And that's really the heart of it, isn't it? That nearly $1,000, it could be yours. So the real question is, are you just going to keep leaving it on the table? This isn't about some abstract economic theory. This is about your money, your future, and the choices you get to make.
To make this all feel a little more real, let's follow someone's journey. Let's meet Alex. Alex is 26, makes a pretty decent living, but honestly is confused about pretty much all of this money stuff. And you know what? A lot of what's about to happen to Alex has probably already happened to you. Their journey is going to become our roadmap.
Okay, so where do we even begin? Let's start with the things that are messing with your money without you even touching it. I call them the invisible forces, constantly running in the background of your financial life: inflation and credit. Understanding these two is step one to taking back control.
You've definitely felt this one, especially at the grocery store. Inflation is basically why the same cart of food costs way more today than it did a couple of years ago. We saw it peak at a crazy 9.1% back in 2022. But here's the part that trips everybody up. When you hear that inflation is cooling down, that doesn't mean prices are dropping. Nope, it just means they've stopped going up quite as fast. Think of it like a car that was going 90 miles an hour, slowing down to 25. It's still moving forward.
So, last year, Alex finds the perfect apartment, applies, feels good about it, and then gets rejected. No real explanation, just a quiet no. And the culprit? It was a 3-digit number Alex barely even understood: their credit score. This little number follows you everywhere and has a huge impact on your life. And when you actually break it down, it's surprisingly simple. Forget all the mystery. Your credit score really comes down to just two main things. First, do you pay your bills on time? That's a whopping 35% of your score right there. And second, how much of your available credit are you using? That's another 30%. Just those two habits make up 65% of your score. That apartment rejection, it's what finally pushed Alex to check their score for the very first time. And this quote just says it all. Having a lower score literally means you pay more for the exact same things. On a typical mortgage, for example, the difference between having excellent credit and just fair credit can mean paying an extra $60,000 to $90,000 in interest for the same house from the same bank. It's basically a penalty for not knowing the rules of the game. So, if inflation and credit are these invisible forces acting on you, let's flip the script. The next step is to decode the rules of the system so you can start using them to your advantage. This isn't about playing defense anymore. This is about going on offense with your money. So Alex just got offered a big promotion, an $8,000 raise. But instead of just pure excitement, there was this little nagging anxiety. Wait, what tax bracket does this put me in? Am I actually going to take home less money? And this fear is so common. 51% of Americans worry about the same thing. Some have even turned down raises because of it. But that fear is based on a total misunderstanding of how taxes actually work. In the US, we have what's called a progressive tax system. Think of it like filling up buckets. Your first chunk of income is taxed at the lowest rate. Once that bucket is full, the next chunk of income is taxed at the next, slightly higher rate. A raise just means that only the new money, the extra dollars, fall into that higher bucket, not your entire salary. So let's just be crystal clear and bust this myth once and for all. A raise will never mean you take home less money, period. It is mathematically impossible. Alex took the raise, you should too. And please, tell a friend. Okay, let's talk about debt. Now, not all debt is the big, scary monster we think it is. There's good debt, which is when you borrow money to buy something that will likely go up in value, like a house. Then there's bad debt. That's for things that lose value the second you buy them, usually funded by high-interest credit cards. One builds your future, the other pretty much destroys it. And Alex, well, like most of us, had a little bit of both. Now for the exciting part. Seriously, we've talked about the forces and the rules, so let's get to the tools. These are the powerful engines you can use to actually proactively build wealth over your lifetime. We're talking about compound interest and the 401k. People sometimes call compound interest magic, and honestly, over long periods of time, it really does look like it. All it means is that you earn returns not just on the money you put in, but on the returns you've already earned. It's like a snowball rolling downhill. It starts slow, but then the growth just accelerates and becomes this unstoppable force in your financial life. Now just look at this. This slide shows why when you start is so much more important than almost anything else. If Alex starts investing just $250 a month at age 25, they could have almost $900,000 by retirement. But if they wait just 10 years and start at 35, that final number is less than half. That 1 decade of waiting costs them over $500,000. Time is the most valuable tool you have. Okay, so knowing how powerful that is, what percentage of workers who have a 401k available to them actually use it? The answer is just 52%. That's it. That means almost half of all eligible workers are leaving one of the best wealth-building tools just sitting there on the table. And what they're leaving behind is just staggering. See, a lot of companies offer a 401k match. That's where they put money into your account just because you did. It is, and I mean this quite literally, free money. It's the easiest raise you will ever get in your entire life, and all you have to do is say, yes, please. So after learning this, Alex logged into their company's benefits website. You know how long the whole process took? 4 minutes. 4 minutes online. And in those 4 minutes, Alex started claiming money that was already part of their salary package, money they had just been leaving behind month after month. So let's zoom out for a second and connect all these dots. We've touched on inflation, credit, taxes, debt, investing, but what does it all really add up to? Why is understanding this stuff the actual key to changing your entire financial life?
Well, let's just check back in with Alex. Just by understanding these basics, Alex took the raise, enrolled in the 401k, started investing a little bit each month, paid down some of that high-interest debt, and checked their credit score. None of these are giant, life-altering leaps. They're small, smart, informed steps that completely change the direction of your financial future.
And this right here, this brings us to the single most important idea in this entire explainer. The financial system is not confusing by accident. For so many businesses, your confusion isn't a bug in the system. It is the business model. It creates dependency. It allows them to sell you things you might not actually need. And your best defense isn't being some kind of expert. It's just knowing the basics.
Look, you don't need a hedge fund or a trust fund to win at this game. You just need to know the rules well enough to not get played. So I'll just leave you with this one question to think about. Now that you know the basics, who does your money really work for? Them or you?